Let's talk about job order costing. So in job order costing, we're going to explain a little bit of the difference between process costing and job costing here in a second. But what I need you to think about just for a minute is the product cost that we learned about in the last chapter. Remember, we can classify cost by their function, and we said that the way you classify by function is whether they are period cost or product cost. And just to recall, product cost are direct material, direct labor, and overhead, factory overhead, manufacturing overhead, overhead in general. That's what you have to think about. Remember that in product costs, everything that is a product cost is something that happens in the factory. It's not selling and administrative expenses. It's stuff that happens in the factory. So those are the costs that we're talking about today, are product costs. But we really want to focus on the job costing part of it. You see there on the screen that we're going to talk about process costing more in a few chapters. Job costing is when we start to separate our product cost in detail by the job or by the project. But in job costing versus process costing, we're really talking about the production of large, unique, high-cost items, things that we can easily trace directly to a job. The example for job costing for me that I always think about is building a house. It's easy for me to trace cost to a geographic location that is isolated. And when you build a house, obviously your costs can be isolated. Labor, material, everything can be isolated there. So things like that, whereas process costing is going to deal with the mass production of something like chocolate chip cookies or bottled water, things like that. There's again just a difference between the two for job order operations. Again, it shows you on the left that we're dealing with very customized type things, whereas on the right for process operations, we're dealing with mass produced type stuff. This is just a little bit of job order production activities. So we really kind of stopped here in the last chapter, kind of explaining the types of costs that happen in the factory. These are your product costs: material, labor, and then overhead. Remember, overhead is defined as anything that's not direct material or direct labor that happens in the factory. So indirect materials, indirect labor, and anything else that would happen in the factory, like the rent, the utilities, the janitorial team, those are the things that are going to be overhead. But what we're going to focus on today is that we are now seeing that we can take these costs and we can assign them to specific jobs so that we can track the cost of each job. And why is it important? I mean, you see that it looks like there's different cars here or what we're dealing with. And you'll see a little bit more. It's actually not the cars. It's actually alarm systems going in the cars, I think. Why is it important that we figure out what the cost of job B15 is, or the cost of job B16, or the cost of job B18? And I'll tell you that it's twofold. Figuring out the cost of job B15 is important because you need to know how much to sell job B, or what kind of price to put on job B15. How do you ever know what to sell it for if you don't know what it cost, right? So we need to figure out that cost. Not only that, but if you are unable to control your cost, I mean, so if something is costing too much, you need to be able to identify it. And if you can isolate it into one specific area, then it makes it much easier to deal with. So we're going to take a look at a job cost sheet. It's we call it the primary, and I'm going to do air quotes here, document. Not much is happening on paper anymore. I know that my first job out of college, this is what I did. So this is job costing is my niche, without a doubt. But we did this all on paper. Obviously, we now have computer systems to do this for us. And this is a screenshot out of an old accounting system called Peachtree. I think it's called Sage 100 or something now. But you'll see what's happening here. This is a job cost sheet for customer Carol Connor. It's job number B15, if you remember the little picture in the diagram before. She lives in Malibu, California, and she's having a level 1 alarm system on a Ford Expedition installed. Okay, we promised it to be done by March 15th. We started it on March 3rd. Actually got completed on March 11th. And what's happening? Well, we have three primary columns down here for direct material, direct labor, and overhead, and we're tracking all of our costs. This is all the direct material that went into this job. Here's all of the time that was spent on this job for labor, and then we have our overhead piece, which we're going to explain in a little bit more detail in a minute. But when we add these three things up, you'll see we summarize it, and it looks like our cost, right? Cost to the company. This isn't what we sold it for. Our cost is $3,200. So hopefully we're selling for more than $3,200. $3,200 to put an alarm system in a Ford Expedition sounds pretty crazy to me. I don't want to know what Carol's hauling around in that Ford Expedition. Sometimes it's just better not to ask, right? So let's see how we got all that there. Let's talk about direct material first. I need you to go back to that visual that we had last time in the previous chapter about when we were doing bicycles, right? John was having to go to the raw material storeroom and get the parts that he needed so he could bring them out to his bench in the factory floor and put a bicycle together. Well, he didn't just get to walk into the raw material storeroom and take whatever he wants and not tell anybody, right? We've got to have some type of transfer of information to know that something left that storeroom and is now on the factory floor. And that's what a materials ledger card is. So if you could just imagine a bunch of, I don't know, bins sitting around in the storeroom, and they all have this card maybe attached to the front of it. And what this card does is it tells us in the storeroom, this stays in the storeroom, tells us what's in the bin and how stuff got to the bin and how stuff got taken out of the bin. So this is bin number 137 for stock M-347. It's the alarm system wiring. It looks like they like to have no more than 5 units on hand, no less than 1 unit on hand, and when they get down to 2 units, it's time to reorder. It started out with 1 unit on hand. It looks like they bought another 2 units for $225. So after they did this, they now have 3 units on hand that cost $225 a piece for a total inventory value of $675 in this bin. But then on March 7th, someone turned in a requisition 4705 for 1 unit. Well, when they took this 1 unit out of the bin, it left them 2 units on hand, right? I mean, that makes sense. So this material ledger card is sitting in raw material in the raw material storeroom on that bin. Here's that requisition, number 4705. It was requested by C. Luther. You'll see what it was. He requested for job B15, stock item number M-347, asked for 1, and the person who works in that storeroom who fills these orders signs off on it as well. So it looks like M. Bateman actually provided this one. He's the one. M. Bateman is the one who fills out this material ledger card. M. Bateman is the one who actually creates all of these. It's his responsibility to keep track of what's going on in the storeroom. What do we care in accounting? We just want to know how much to charge out, right? So here it is. We've gotten information about all of the direct material on all the jobs. If we add all of the jobs up, it's $1,800. We're not going to deal with indirect material yet because we're only looking at direct material because we can't push indirect material into work in process. It's not where it goes. We'll talk about that in just a second. But so we only want to deal with this 1,800, so it comes out of raw material inventory, right? Inventory is an asset account, so it normally has a debit balance. So when all of this was in the raw material storeroom, it had a value of 1,800 debit in raw material inventory. We're now just taking that out of raw material inventory and debiting work in process inventory for that same value. The parts went to the bench on the factory floor. That's basically all that's happening. Then we've got to deal with labor. What happens with labor? Well, people are filling out, time sheets, maybe their salary contracts, things like that. But time for direct labor goes straight into work in process and gets recorded on those job sheets. If it's indirect labor, like anything indirect, it has to go to the factory overhead ledger before we can do anything with it because it just can't go to straight to work in process. Remember, we can't trace it. We can't trace anything indirect specifically into a job. Remember that whole classification by traceability, the direct versus indirect. How do we get labor information? Probably not on a time card anymore. People are probably using some kind of iPad or some digital device to track their time. But this is the time for T. Zeller, working on job B15, spent 3 hours on it at $20 an hour, and C. Luther approved it. C. Luther is obviously the foreman for the job. What do we care in accounting? Well, we want somebody just to tell us how many dollars got earned on each job. That gets us to a direct labor piece. We don't care quite about the indirect labor at the moment. We just want to deal with the direct labor piece because I've got to get that recorded and work in process. So we make a journal entry, 4,200 of payable, right? We owe this out to people. If we were paying them in cash, we'd just go ahead and credit cash. But we're going to put that into our work in process inventory as a debit. It's the labor spent at the bench. But let's talk about that overhead. Because if we went back to that job cost sheet, that primary document that we had there, you would have seen that we just charged $1,600 out to job B15. Just a flat out $1,600, and it said that it was based on 160% of direct labor cost. Well, the truth of the matter is that factory overhead is kind of hard to allocate to job B15 because remember, factory overhead is stuff like the rent, the factory supervisor, the janitorial team, the utilities. I mean, how do we know how much electricity we used up on the factory floor that should go into an alarm system wiring for doing job number B15 on that Ford Expedition? You don't. So when we have indirect cost, indirect material, indirect labor, and everything else that happens on the factory floor that's not direct labor and not direct material, we just charge it into a factory overhead inventory account. So everything just gets going there. As it happens, we put it into factory overhead. So factory overhead, this bucket of money just keeps building and building and building because we keep charging stuff to it. How do we ever get money out of it and apply that money to job B15? Because B15 needs to have just a little piece of overhead applied to it. There's no question about that. So in order to accommodate this problem, what we do is we create a predetermined overhead rate. It's basically an educated guess, and whatever that rate is, we apply it based on some type of driver, some activity base tells us how we can apply that out. So the first thing that happens is management sets a predetermined overhead rate. Typically at the beginning of the accounting year is when we set this predetermined overhead rate. It doesn't necessarily stay the same year over year because it's based on an estimate, and we need to change that estimate from time to time. If you never change your overhead rate estimate, something's wrong. We apply estimated overhead to those specific jobs. For this company, we're applying it out at 160% of direct labor cost. You will usually see overhead applied based on labor simply because labor changes for every job. You might spend more time on this job, less time on the other. So it's probably a good idea if you've got a labor intensive type job to base it on labor. It can be done on direct labor dollars, or it can be done on direct labor hours. It's really just management's choice. So we apply that overhead based on the estimate to the jobs. But remember, all along, we've been putting actual overhead in the factory overhead ledger. This is where we've been, charging the rent, charging the supervisor, charging the janitor, right? We're actually pushing that into an overhead account. So what happens? If I'm debiting this account for real overhead, and when I apply it to jobs, I'm crediting the account, then most likely I'm going to have money, either too much money left in the account because I didn't take enough out to go to jobs, or I took out too much money and I'm going to have a negative. And that's why we would need to eventually adjust the overhead. So we set the rate, we apply it, all the while we're recording actual. At some point we adjust overhead and we go back and we do another predetermined overhead rate. Quite often this happens at the end of the accounting cycle. It doesn't happen on a monthly basis, weekly basis, but it could. It just depends on how management wants to deal with it. So let's figure out how we set the predetermined overhead rate. Road Warriors bases this predetermined overhead rate and applies it based on direct labor cost. So how do they figure out the rate? Well, what they did is they sat down at the beginning of the accounting cycle and they estimated what they thought their total overhead costs were going to be. All the rent, the supervisor salary, how much do we pay the janitor, how much is depreciation, all that kind of stuff. So they kind of created a budget. for all of their overhead cost, and then they divided it by what they think all of their direct labor cost was going to be. So they took all their estimated overhead cost divided by their activity base, which is direct labor cost, and came out with a predetermined overhead rate of 160% or 1.6. What do we do in accounting? Well, when we see what all of the direct labor cost is for each job, we just multiply it by the predetermined overhead rate. Makes it nice and simple, right? Because we've just got this standard rate. So if B15 had direct labor cost of $1,000, we multiply that by 1.6 and we just go ahead and push 1,600 into job B15. 800 for B16 times 1.6, we push 1,280 out of factory overhead and into work in process inventory. Obviously, we just want to summarize it and do it all at once. So here's all the jobs. $6,720. We take it out of the factory overhead bucket. Remember, all those costs went into factory overhead as a debit, so now they've got to come out as a credit, and we move it into our work in process inventory. Again, how do we get the real overhead in there? Well, it's everything else, right? So remember that indirect material from a few slides back? We did the direct material only, but there was 550 of indirect material, and I said, we'll have to deal with it later. Well, it was indirect. Where did it come from? It still came out of raw material inventory. It's probably stuff like screws and nuts and bolts and things like that, wire nuts, whatever. Still came out of raw material inventory, but instead of being traced directly to the job, it had to go into factory overhead. Same thing happens with the labor. This is the supervisor's labor. He's not actually doing the alarm system wiring. He's not working on job B15. He's just making sure that everybody's doing their job. Well, he's indirect labor. I can't trace it directly to the job. It has to go into factory overhead. And then we have all the other stuff, depreciation on the equipment, the rent, the utilities, prepaid insurance, all those things. So we pushed out another $5,270 to factory overhead. And then you'll see, here's the summary of cost flows for our manufacturer. Again, raw material inventory gets pushed into work in process. If there's indirect material coming out of here, it would have gotten pushed over into factory overhead. We don't see that piece here. But work in process gets the overhead applied, direct labor, direct material. When it comes out of work in process inventory, it gets a credit to that account and debits finished goods inventory, meaning it's now available for sale. And then once it's sold, it comes out of finished goods inventory and gets pushed over to the income statement as cost of goods sold expense. Expanded summary of cost flows. Again, we've kind of seen all this. We just saw this on the prior slide, but now we have detail. We have detail about all this because we can see how much is in job B18, how much is in 19, how much is in 17, 15, 16. Why is it important? Again, it's important because I need to know how much I should sell job B17 for. What's the price? Did I quote her $3,500 on the job and it cost me $3,360? And maybe I don't have enough markup in it, right? And if that's the fact, maybe I really wanted 100% markup and this thing ended up costing me, way too much, right? So a lot of good information comes out of being able to identify exactly how much these jobs cost. There's all the journal entries that we just saw a few minutes ago. Remember, here's the raw material, the direct material, there's the direct material. We had the direct labor. We had the indirect material, indirect labor. All of those that we just did are right there in that summary. And when we have all of that, we can get that cost of goods manufactured. Remember how we do this? It was from the previous chapter. I told you this formula is important. We're going to use it all the time. We always take our beginning, right? Here's our beginning. It happened to be 0, right? We add in whatever we did, whether it was purchased or cost of goods manufactured, right? So there's our beginning. We add in our production for the month, take away our ending work in process, and it tells us what our total cost of goods manufactured is, that $8,940. Remember I told you that because we use a predetermined overhead rate, then most likely we're probably going to have some money left in factory overhead or too much taken out. This is a T account, right? So when we actually put the rent into factory overhead, when we put the supervision into factory overhead, it was a debit over here on this side. The actual amounts got debited. And when we applied factory overhead to jobs, it came out of the account as a credit. So if you had a debit over here of $10,000, but you only took out $8,000, you've got a $2,000 debit left over. What happens if we have a leftover debit in factory overhead? Here's the debit. It means that our actual was greater than our applied. That makes sense. And it means that we are under applied. We didn't take enough out and push it to the jobs. Where do we make the adjustment? We're just going to push into cost of goods sold. So if I had a debit balance in factory overhead, I need to credit this account in order to get rid of the debit balance. So I'm going to credit factory overhead, whatever the number is. I think we use 2,000 as the example. Therefore, we would just debit cost of goods sold $2,000 and we're done. On the other hand, if 10,000 was our actual and we pushed out 11,000, then we're $1,000 over applied. We have $1,000 too much going to the jobs, right? Actual is less than applied in this case. That means we have a credit balance in factory overhead that we need to get rid of. Well, how do you get rid of a credit? You're going to debit the account, right? And if you're going to debit factory overhead by 1,000, you're going to have to credit cost of goods sold to get rid of it. Okay, underapplied or overapplied, if we went back through and looked at all those entries that we did, if we actually created a T account for factory overhead, we would see that factory overhead was left with a debit balance of 480. That means that it was underapplied. If it was underapplied, we need to credit it out, and we're just going to push it into cost of goods sold. And that is the end of our chapter.